Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the crude oil, RBOB, and heating oil markets for Thursday, July 14th. Starting off here with an intraday 4-hourly chart of the August crude oil contract. As of late last week and early this week, we had advised traders to move back to a neutral sideline position as a result of the confirmed bearish divergence in short-term momentum when the market broke below the 95.90 corrective low last Friday, exposing a deeper correction or reversal of the late June, early July rally from 89.61 up to that 99.42 high from last week. Since then, however, on Tuesday, the market reversed that interim setback attempt with a confirmed bullish divergence in momentum back above 95.94. That especially stemming from the area of the 61.8% retrace of that previous rally around 93.36. We believe the market has defined the 93.55 low from Tuesday as one of developing importance, and on the heels of a larger degree low from June 27th at 89.61, we feel that the market might be providing the reinforcing evidence of a broader basing and reversal environment that could expose surprising gains if the market can get over this 99 the figure, 99 handle resistant hump. In this regard, traders are advised to move to a neutral to cautiously bullish policy with a clear break above last week's 99.42 high required to really expose a run to the upside. We want traders to tread very cautiously, however, because as long as that 98 to 99 handle area resistance remains intact, there are some caveats in the form of looking here at a daily log close only basis, a ton of former price action throughout most of May and early June that supported the market back in May and early June that now is considered resistance. Also, quite specifically, the 98.67 high close from July 7th came within just a few cents of the 38.2% retrace of the entire late April to late June sell-off from 113.93 to 90.61, again on this log close only basis. You can see if the market can reinstate at least the intermediate term trend is up above this entire 98.99 handle area resistance, the market could run quite a lot. From a longer term constructive view, looking here at a weekly log scale chart, we have approached the May-June setback attempt first as a major bull market correction, given the secular nature of the long-term bull trend here, and an area of former resistance between the 87 handle from May of 2010 and the late December, early January resistance around the 92-93 area. If this market is still truly strong from a long-term secular perspective, then we fully expect this 87 to 93 range to hold as new support. And thus far it's done that. Also 87.81 is a 50% retrace of the 2010-2011 rally, contributing to this area as a tremendous support candidate. It's also interesting to note the bullish consensus measure of market sentiment. The May-June setback attempt has caused that to erode to a 46% level a couple of weeks ago. That's the least bullish this market sentiment condition has been since that accompanied February's corrective low ahead of a resumption of the major bull trend. Additionally, looking here at a daily log scale bar chart, the sell-off attempt from that May 2nd intraday high at 114.83 down to the recent 89.61 low from late June clearly thus far is only a three-wave sell-off attempt, left unaltered by new lows below 89.61, and especially within the context of the secular bull trend, this sell-off attempt easily can be considered corrective and supportive of the secular bull trend. Again, with a break above this 99 handle area, possibly reinstating that secular bull trend to new highs above 115. But while this resistant hump remains intact, traders are advised to tread cautiously but constructively, and per such, a neutral to cautiously bullish policy is advised, with a failure below Tuesday's 93.55 low sufficient to threaten that view enough to warrant moving back to a neutral sideline position. Moving to the August RBOB contract on an intraday 4-hourly basis shown here, details the past few weeks' continued impulsive behavior up, and by virtue of yesterday's and overnight's gains above the recent 312.95 high, reaffirming this developing bull trend. The market has defined Tuesday's 302.5 low as the latest corrective low and tightest risk parameter. This market is now required to fail below to stem this recovery and expose a larger degree correction or reversal lower. In lieu of such sub 302.5 weakness, further and possibly accelerated gains remain anticipated. We want to be particularly watchful for such a short-term risk parameter, however. Looking here at a daily close-only basis on a linear scale, you can see the market has reached the area around 313.77. That is a 61.8% retrace of the entire late April to late June sell-off from 339.84 down to 271.59. If there's amidst waning upside momentum, looking here at a daily log scale bar chart perspective, you can see the slowdown in the rate of ascent over the past week and a half or so, indicated here by the relative strength indicator of momentum. And if the market cannot sustain recent gains above that 302.50 short-term low, it will confirm that momentum failure. That from this area around the 61.8% retrace, we would then have to assume the market would be vulnerable to a larger degree correction of this recent recovery, or quite possibly a resumption of the May-June broader sell-off. In lieu of such sub 302.50 gains, losses, further and possibly accelerated gains remain anticipated, and as such, a bullish policy remains advised. Finally, looking here at an intraday 4-hourly chart of the August heating oil contract, you can see the past couple of weeks clearly developing uptrend and up channel with a failure below Monday's 303.76 corrective low. The tightest corrective low and the tightest risk parameter we believe this market is now required to fail below to threaten this uptrend and expose at least a steeper intra-range setback, if not an entire reversal of the past couple of weeks' gains. It's important to note here on a daily close-only basis, the market's position right around the 310.93 area that marks the 61.8% retrace of the entire April through June sell-off from 331.97 down to 276.89. Prior to this current recovery, after the initial sell-off April through May from 331.97 down to 284.51, the market retraced exactly to that 61.8% retracement area before relapsing in a pretty significant way. This current 618 retrace cutting across the 310.93, the market's trading right in that area. We want to be particularly watchful for any kind of short-term momentum failure that could morph into a larger degree correction of this recent recovery or resumption of the broader bear trend, and we believe that threat will be heightened if this market cannot sustain recent gains above 303.76. As long as it does, this uptrend is considered intact, and further and possibly accelerated gains should not surprise at all. Per such, traders remain advised to maintain a bullish policy with protective sell stops at 303.76, the break of which we want to move to a neutral sideline position. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.